Welcome to our deep dive into the fascinating world of investment strategies, where we'll explore the contrasting philosophies of two legendary investors, Warren Buffett and Michael Burry. Think of investing like a game of chess. Each move requires careful consideration, foresight, and a keen understanding of your opponent's strategy. Buffett, often referred to as the Oracle of Omaha, plays a long game, focusing on value investing. He seeks out companies with strong fundamentals and holds on to them for the long haul, much like a chess player who patiently develops their pieces for a strategic endgame. On the other hand, we have Michael Burry, known for his bold and often contrarian approach. Burry is famous for his prescient bet against the housing market before the 2008 financial crisis, showcasing a more aggressive and tactical style. He's like a chess player who isn't afraid to sacrifice a piece for a greater advantage, always looking for opportunities where others see risk. Understanding these two distinct strategies is crucial for anyone looking to navigate the stock market effectively. Whether you lean towards Buffett's steady, methodical approach or Burry's dynamic, risk-taking style, there's valuable insight to be gained from both. In this video, we'll break down their philosophies, analyze their key moves, and help you determine which strategy might resonate with your own investment journey. So grab your chessboard and let's get started. Warren Buffett's investment philosophy. Warren Buffett's investment philosophy is rooted in the principles of long-term value investing, where the focus is on identifying companies with strong fundamentals and intrinsic value. At the heart of Buffett's strategy is fundamental analysis, which involves evaluating a company's financial health, management quality, and competitive advantages. He believes that by understanding a company's true worth, investors can make informed decisions and avoid the pitfalls of market speculation. Patience and discipline are crucial components of Buffett's approach. He famously advises investors to be fearful when others are greedy and greedy when others are fearful. This mindset allows him to remain calm during market fluctuations, waiting for the right opportunities to invest in undervalued companies. Just like a chess player who carefully considers each move, Buffett takes his time to analyze potential investments, ensuring that he only commits to those that align with his long-term vision. Buffett's chess-like moves in selecting undervalued companies often involve looking for stocks that are trading below their intrinsic value. He seeks out businesses with strong cash flows, solid management, and a durable competitive edge. By doing so, he positions himself to benefit from the inevitable market corrections that will bring these undervalued stocks back to their true worth. This strategic patience not only minimizes risk, but also maximizes potential returns over time. In essence, Buffett's investment philosophy teaches us that success in the stock market is not just about quick wins, but about making calculated, informed decisions that stand the test of time. Michael Burry's contrarian approach. Michael Burry's investment tactics are characterized by a unique contrarian mindset that sets him apart in the world of finance. He has a keen emphasis on identifying market inefficiencies, often spotting opportunities where others see only risk. Burry meticulously analyzes data and trends, allowing him to assess potential pitfalls that the broader market may overlook. This focus on risk assessment enables him to make informed decisions that can lead to significant gains, even in turbulent times. What truly defines Burry's approach is his willingness to go against the crowd. While many investors may follow popular trends, Burry is known for taking bold positions that challenge conventional wisdom. For instance, his famous bet against the housing market before the 2008 financial crisis exemplifies his contrarian nature. He recognized the signs of an impending collapse when most were riding the wave of a booming real estate market. This ability to think independently and act decisively is a hallmark of his investment philosophy. Using chess strategies as a metaphor, Burry's tactical maneuvers in volatile markets resemble a player who anticipates their opponent's moves. He carefully positions his investments, often making calculated sacrifices to gain a strategic advantage. Just as a chess master might sacrifice a pawn to set up a checkmate, Burry is willing to take risks that others shy away from, all in pursuit of greater rewards. His approach teaches us that in investing, sometimes the best moves are the ones that defy the status quo, leading to opportunities that others might miss. Comparative analysis of strategies. When we compare the investment strategies of Warren Buffett and Michael Burry, several key differences emerge, particularly in their approaches to market trends and risks. Buffett's strategy is rooted in a long-term perspective, focusing on stable, fundamentally sound companies that he believes will grow over time. He tends to avoid market timing and instead emphasizes the importance of holding investments through market fluctuations. In contrast, Burry thrives on identifying short-term market inefficiencies and is willing to take calculated risks that others might avoid. His contrarian approach often leads him to invest in sectors that are out of favor, betting on their eventual recovery. These differing philosophies significantly shape their decision-making processes. Buffett's method is characterized by thorough research and a disciplined adherence to value investing principles. He seeks companies with strong fundamentals and a competitive edge, making decisions based on intrinsic value rather than market sentiment. Burry, on the other hand, is more reactive to market signals, often pivoting quickly based on emerging data and trends. His willingness to challenge prevailing narratives allows him to capitalize on opportunities that others may overlook. Using chess analogies, Buffett's strategy resembles a player who methodically develops their pieces, focusing on a solid defense and a long-term strategy. Burry, however, plays like a tactical genius, making bold moves that disrupt the status quo, often sacrificing pieces for a greater advantage. Together, their contrasting strategies offer valuable insights into the diverse approaches to investing, highlighting that there is no one-size-fits-all method in the complex game of the stock market. Market trends and tactical moves. The investment strategies of Warren Buffett and Michael Burry significantly influence market trends, often setting off ripples that can alter stock market dynamics. Buffett's long-term value investing approach tends to stabilize markets, as his investments in well-established companies often lead to increased confidence among other investors. For instance, his substantial stake in companies like Coca-Cola and Apple not only boosted their stock prices, but also encouraged other investors to follow suit, reinforcing the notion of these companies as safe, reliable investments. Conversely, Burry's tactical moves can create waves of volatility. His bold decision to short the housing market before the 2008 financial crisis is a prime example. By betting against mortgage-backed securities, he not only profited immensely, but also drew attention to the underlying risks in the housing market, prompting other investors to reconsider their positions. This kind of contrarian strategy can lead to rapid shifts in market sentiment, as it challenges prevailing assumptions and encourages a re-evaluation of risk. Relating their tactical moves to chess strategies, Buffett's foresight resembles that of a player who carefully plans several moves ahead, ensuring that each investment aligns with a broader strategy. His patience allows him to wait for the right moment to make his move, much like a chess master who bides their time before launching an attack. Burry, on the other hand, embodies the tactical genius of a player who seizes opportunities as they arise, often making bold sacrifices to gain a strategic advantage. Together, their approaches not only shape their own investment outcomes, but also influence the broader market landscape, demonstrating the intricate interplay between strategy and market dynamics. In this video, we've explored the contrasting investment strategies of Warren Buffett and Michael Burry, two titans of the financial world whose approaches offer valuable insights for investors. Buffett's long-term value investing philosophy emphasizes fundamental analysis, patience, and discipline, focusing on companies with strong fundamentals and intrinsic value. His strategy promotes stability and confidence in the market, encouraging investors to adopt a similar mindset. On the other hand, Burry's contrarian approach highlights the importance of identifying market inefficiencies and taking calculated risks. His willingness to go against the crowd can lead to significant gains, especially in volatile markets. Understanding these differing philosophies is crucial for anyone looking to navigate the complexities of investing. Each strategy has its merits and can be adapted to fit individual risk tolerances and investment goals. By learning from both Buffett and Burry, investors can develop a more nuanced approach to their own portfolios, balancing long-term stability with tactical opportunities. Thank you for watching, and don't forget to subscribe to our channel for more financial insights and analysis. Check out this next video.